Hey, what's up everyone? Rosario here and welcome to Modern Finance. There are some serious indicators floating around right now that I think could point to either market stagnation or a serious market downturn. Stay tuned to find out why and how this could happen. Before we get started, please remember to smash the like button and subscribe to the channel. It really helps us out and it costs you absolutely nothing. Okay, what I want to talk about is 5 things. The first indicator of a potential market crash in the US and Canadian stock markets is China. Yes, China. The reason for this is that China has a lot of manufacturing, and with the Rona, they were out in front of the US in terms of cases and reopening. So what we've seen in China can then be extrapolated to predict a little bit of what we can see in the US. What we've seen in China over the last few days is a massive crash in Chinese tech stocks. I don't like this because I actually hold a lot of tech companies myself, but I'm looking for everything that contradicts what I think is going to happen. And I think what's happening in China may be an indicator of what happens here in the US. The Chinese stock market, especially tech stocks, have severely underperformed in 2021. If you take a look at the graph up on screen of the Shanghai Composite Index, we can actually see that the market today is actually at the exact same level that it was in January of 2021. So we've basically seen no growth in the Chinese stock market over the last 7 months. Okay, admittedly, China's a very different market from the US, but it's the second largest economy in the world. And to date, they've been a really good predictor for what's going to happen in terms of the market coming out of the Rona recession. If China was the only indicator of a pending market crash, I don't think we'd be too worried. But the second comes directly from the US, and that's the fact that banks are holding on to more cash than they've ever had before. Banks in the US are engaging with the Federal Reserve in something called a reverse repo transaction. And what that is essentially is that the banks, in order to not have so much cash on hand, because the bank having your cash on their balance sheet is actually a liability to the bank. So the banks want to make sure that their liabilities aren't too large. What's happening right now is that banks are investing more and more in the Federal Reserve's reverse repurchase agreement. What this means is that banks have a lot of cash on hand that comes from deposits, and that means that they have a liability on their balance sheet. Banks are afraid to lend that money out for a number of reasons, but the fact of the matter is that banks are not lending this cash out. What they're doing is going out to the banks and buying these reverse repurchase agreements, and overnight they'll trade them back. They show enough assets on their balance sheet to comply with federal regulations. While major mainstream media outlets are saying this is nothing to be concerned about, I'm a little concerned because if banks aren't willing to lend out the cash that they have to other people, maybe that means that they're afraid that people are going to default on their loans. While people have higher levels of cash than ever before, this could indicate that banks see an economic downturn or people's inability to pay back their loans as a real risk in the future. The third indicator of a potential market crash actually comes in the sign of a potential reduction in at least the rate of growth in housing prices. So what we're seeing right now are more houses coming onto the market and a greater supply of houses up for sale and fewer houses closing. So what that means is while there's more supply, people are putting their houses onto the market and they're still putting them on the market at higher and higher prices. Sales of new homes and of homes that are coming onto the market are actually falling. This is the first time that we've seen something like this since the early part of the pandemic. So it could signify a slowdown in the housing market. Banks haven't yet raised interest rates. What you can expect is that a 0.5% rise in interest rates will lead to a 10% reduction in housing prices. And this has been historically the case. When you see interest rates rise, people are able to afford less house, so housing prices come down. The only way to take advantage of this if you're purchasing a new home is to get in right when this happens. So when interest rates first come down, housing prices haven't yet had a chance to go up. If you see a change in interest rates happening, you need to take advantage of it quickly. But often the price of houses actually adjusts faster than the price in interest rates. So this leaves a lot of young and new buyers out in the cold because they're not able to take advantage of these reduced interest rates. Tied into this increase in real estate prices is actually an increase in rental prices. Rental prices have increased at the fastest rate in a long time. Rent and housing makes up the largest percentage of people's income, especially their non-disposable income. So what that means, to me at least, is if people are not able to afford their rent, then I think that means they're not going to be able to afford to purchase discretionary things. And we've actually seen a fall in discretionary income in the past few months. So if people's rent and cost of housing is going up, that means they have less money to spend on other things in the economy, which could be an indicator of an economic slowdown. If companies underperform on their earnings because people are spending less, this could lead to some economic trouble and potentially a slowdown in the market when companies miss their revenue targets. This leads me into my fifth point, and that's the reduction in disposable income. What we've seen over the past year is that people have higher and higher levels of savings and higher disposable incomes. I think this is largely a result of increased government stimulus and especially unemployment benefits. What this means for the average American is that people have over $3,000 more per month on average to spend on discretionary things. So people during the pandemic weren't able to go out, weren't able to purchase things, weren't able to go on trips. So they'd have more discretionary income to spend on goods. What I think is happening now is we've already seen the transition and people are going back out into the world. Once everyone burns through all these stimulus checks, there's not going to be a lot of money left over for them to continue spending at this rate. We may have already seen or are about to see peak spending. If spending peaks, that means companies will not likely be able to continue raising their prices because there won't be as much demand. It'll mean that companies will have to actually pull back. We might actually see sales and revenue lag in the coming quarters, so Q3 and Q4 of 2021. If you're interested in learning more about this, Meet Kevin has actually talked about this a lot in his videos. I think he covers it really well. And while I personally think that the amount of money that the government has dumped into the economy must be causing some sort of inflation, Meet Kevin makes a really strong argument for the fact that we could see this transitory inflation that the Federal Reserve predicts, followed by potentially a period of either lowered inflation back to around the 1% to 2% range or even deflation in some segments of the market. Check out this video where Kevin describes the process by which he thinks this will happen. Finally, I want to talk a little bit about Canada. Canada's been behind the US in terms of reopening, but everything's starting to open up, at least where I am in British Columbia, and I know Alberta is fully reopened now. That's exciting because we can expect to see a boost in sales and growth in the Canadian market. In a video I made last week, I predicted the explosion in growth of a company that I've invested in after it got listed on the Toronto Stock Exchange. And from that video, you'll see that the stock price has definitely shot up since it's been listed. Take a look at that up here. So what do all these signals mean? Well, if the mainstream media and the government is right, it means essentially nothing. Potentially, we'll see continued slowing inflation and continued economic growth. But what if they're wrong? Sometimes they are. It's hard to say. Just be aware that I'm starting to see these indicators. Of course, I'm biased just like anyone else, but you want to understand and see everything that you can and pull in as much information as you can. If this video comes as a shock to you, that's because it's coming as a shock to me too. I've thought that massive inflation and potentially even hyperinflation was coming since I learned that the government and the Federal Reserve printed 25% of all the money that's ever existed in 2020. But what's happening is the Federal Reserve is reducing their money printing, and we could actually potentially see reducing inflation or even deflation in the coming months. Of course, make sure that you do your own research. Given these market crash indicators that we're seeing, what should you do? I see two options of how this could play out. The first one is that I was right originally, and we continue to see inflation. In that case, historically, when large inflation occurs, you see growth in high growth stocks. What happens is money today becomes more and more valuable, so the companies that have greater and greater growth will see better results compared to companies that are producing a steady return. Because if you're looking at a steady return over time in times of large inflation, at least over the long term, you don't really want to hold a company that is going to have consistent revenue. You want to have a company that has growing revenue that's growing at a rate that's greater than the rate of inflation. The second possibility, and the one that I'm leaning more towards now, is actually a period of reduced demand and potentially even a market crash. This could occur as a flattening market where the market doesn't increase for a long period of time and kind of catches up to itself in terms of growth over time. Or it could happen if there's a catalyst, at least, by a serious downturn. So what should you do about this? Well, what I'm doing is I'm actually trying to wait a little while. I always like buying companies when they have value. I look at the market and I look at the company and I see if it's undervalued. And I try to determine what that company's cash flow is going to be over the next 10, even 20 years, because I have a long investment time horizon. Right now, there's not a lot of good deals out there. So I actually think, despite Ray Dalio and a lot of other people saying that cash is trash, that this might be a good time to hold onto your cash and wait for some buying opportunities. If I do start seeing a dip in companies like Tesla, Xro, and Palantir, I might start putting money into the market. As well, if I see a large dip in the price of Bitcoin, I'm going to be buying. But for now, I'm holding on to some cash because I expect by July or August, we'll have a better idea of whether inflation is going to keep accelerating or whether we're going to see reduced inflation or even deflation in the coming months. But guys, what do you think? Let me know what you're planning on doing down in the comments below. Do you think I'm crazy? Do you think I'm onto something? What am I missing? Let me know, and we'll talk to you in the next one. Peace.